Happy Monday out there, Team 42. It's your skipper here, Darius Delta, in our macro minute for Monday, September 23rd, 2024. Hope everyone had a wonderful weekend. Seahawks 3-0. What can be better than that? So, as always, we'll start with the executive summary from today's leadoff morning note. If you would like to review the analysis supporting these conclusions, as well as what specific changes you need to make in your portfolio to remain on the right side of market risk, you need to be a client of 42 Macro. All right, so today's key macro questions are, will Europe throw cold water on a year-end rally? And will China's latest stimulus efforts disappoint investors? Our answers are the now trending contagions or contractions rather, signaled by key leading indicators of European growth are highly supportive of our sanguine medium term, or highly unsupportive rather, of our sanguine medium term grid model projections for the Eurozone economy, so much so that we are comfortable scrapping our green shoots globally theme. The spread between French and German bond yields widened to levels consistent with the 2015 to 16 global industrial recession and the 2010 to 2012 Eurozone sovereign debt crisis amid rising French political uncertainty that is complicating the outlook for fiscal policy. Beijing is stepping up support for the failing Chinese economy right on cue after the Fed's latest monetary adjustments reduced the risk of destabilizing capital outflows via supporting a weak U.S. dollar. This is all going according to our plan, just slower than our initial expectations. Cyclicals are likely to lead the equity and credit markets higher over the medium term. Transitioning to our 42 macro dashboard here. As always, wrapping up with a question from our community. This one's regarding inflation. Says, curious if someone can explain if inflation remains higher than expected, why are we in Goldilocks or deflation? Expect this transition to reflation. And so that's an important question and a consideration to ask, because I think it's important to remind investors that, no one cycle, of which there are sort of 5 to 8 real important business cycles within the business cycle that contribute to the development and progression of the market regime. And inflation is obviously one of them. Our views on inflation is that we see inflation bottoming out in the coming months over the short to medium term, ultimately, and starting to reaccelerate again, as particularly as we get throughout 2025. And that's sort of our non-consensus view on inflation that may cause some problems in asset markets if things like a growth cycle or the liquidity cycle underwhelm our current expectations. Recall that we're calling for growth to persistently surprise to the upside, at least here in the U.S. over the medium term. We're calling for a market acceleration in both U.S. And global liquidity over that time horizon as well. So those are the two things that could offset and more likely overwhelm any sort of miscreants from the inflation cycle, particularly in the context of a Fed that has an asymmetrically dovish reaction function, whereby the deterioration or what we would consider to be a moderation and creation of slack in the labor market is really now in the driver's seat from the perspective of the reaction function and not inflation. Maybe inflation becomes back in the driver's seat in the coming months and quarters, but for now it isn't. We need to take advantage of that as investors. And so I'll wrap it up there. Darius Dale presenting our macro minute for Monday, September 23rd, 2024. Everyone have a wonderful day out there. Best of luck. Catch you back here tomorrow. Cheers.